A stop-loss order is an order to sell a stock once it reaches a certain price. Some investors see it as an insurance policy, like ejection seats for fighter aircraft. While they are useful and life-saving, they can also be very dangerous. Every time the pilot pulls the ejection lever, there's a 1 in 3 chance of suffering spinal damage because the pilot experiences acceleration of 12 to 14 G-forces. Listen to this pilot's experience.
Felt like somebody had just hit me with a train. When I went out into the wind stream, it ripped my helmet right off of my head, broke all the blood vessels in my head and face. My head was swollen the size of a basketball and my lips were the size of cucumbers.
In this video, I'll talk about the dangers of stop losses for long-term investors. Welcome back to Investing with Daren. Click subscribe to stay updated to more videos on investing. Many investors who use stop losses place their order at 10 to 20%, which means that the stock would be sold if the stock price drops by more than 20%. 2022 has been a volatile year. Netflix stock declined 30% before making a partial recovery. Meta stock has declined 27%, and many expect at least a partial recovery over time. Palantir stock has declined 30% year to date, despite stronger fundamentals. Nvidia stock has declined by as much as 27% this year before starting a recovery. Tesla stock declined 30% from its peak of 1,200 to 829 and is now seeing a gradual recovery. If you're a long-term investor who believes in the fundamentals of the company that you are investing in, a stop loss may not be ideal because short-term stock prices may not reflect your belief in the company's long-term valuation. Some large hedge funds could also organize efforts to reduce the stock price to wring it out of retail investors by triggering their stop losses. They then buy the stock and ride the recovery to profits. I know some Tesla investors who had their stop losses triggered in recent weeks, and some have decided to re-enter Tesla stock at a higher price than what their stop loss sold their stock for. Today's episode is filmed at Seletar Aerospace Park, home to a commercial airport, flight schools, as well as aviation industry companies like Pratt & Whitney and Rolls-Royce. This area was originally used by the British Royal Air Force for more than 40 years, from 1928 to 1971. The pilots who flew aircraft here went through rigorous training. I believe stop losses can be a useful tool when used by trained professionals, like ejection seats by military pilots. The use of an ejection seat is always a last resort for pilots when flying a damaged aircraft. They don't want to lose a multi-million-dollar aircraft and would only use an ejection seat when they know that the plane can't be recovered safely. For long-term investors, we usually don't expect our aircraft to crash. It may take a short-term dive, but its fundamentals are strong enough to lift it up over the mid to long term. While most of us don't use stop losses, I'm curious to learn from those who do on how it's been helpful. If you found this video useful, please click the like button. Hit subscribe to stay updated to more videos on investing. Take care and see you in the next one.